Welcome to the Week in Italian Startup, where we discuss the latest highlights happening in the Italian tech and investment ecosystem. Welcome everyone to the Week in Italian Startup, where Nicolo and we dissect only the best news happening in Italy. Welcome, Nick.
Ciao, Jack. Hello, everybody. Welcome back.
All right, let's get going immediately. And this time, let's maybe start from the bottom. You mentioned a great article from McKinsey, which I thought was very, very interesting. So I'm not a big fan of those articles being made from big, large consulting corporation about startup and VC. But occasionally, you have some unconventional wisdom that might be helpful to remind the audience about. So shall we get into that?
Please go ahead. Are you putting it up on the screen, or should we just comment on the key points?
I thought, yeah.
What was the key point that hits you like, oh my god, that's great? So
yeah, a few of them they were not too bad. I might say. So it was cool. So the article is essentially how to build a unicorn, a lesson from venture capitalists and startups, which it's a little bit clickbaity in a way, but there are some good stuff. So first of all, I want to start by, of course, something that seems obvious, but in their angle, they kind of put it in a different way, which is the team, the role of the team and the people. But they underline how exactly the network of the founders is really one of the key elements. And I thought there was not always a point that people kind of analyze when talking about founders in general. So you talk about the founder, you talk about the expertise, the education, but what about the network? How the network was built in the past? What happened before? So I thought it was interesting.
Yep. But team. Everybody in VC knows that team is probably the most important metric, the most important KPI to track and to analyze. Then maybe different investors have different ideas about what's important, what's a good team. But I have to say, McKinsey doesn't go far from the average. I mean, they're pretty clear in their analysis. And let me share with you that just came to mind. The numbers that they have in the presentation, actually, probably they come from another article that I have.
Okay.
That dissected the background of European unicorns.
Interesting.
Yep. At least the numbers match quite a bit.
Awesome. Another element that I thought it was interesting was the $5 trillion number that they mentioned. So the second point was basically that a good VC identifies companies that play in a very large total addressable market, and they kind of put a number into that in terms of aggregate annual revenues of the industry. And they mention how basically some of the major industries like technology, media, and telecommunication in aggregate each have an annual revenue of 5 trillion. So that was particularly interesting to actually put a number on the TAM, which sometimes is tough to pin down. What do you think about it?
That's interesting. I have to say that sometimes TAM is the most important metric, and sometimes SAM, the serviceable available market, addressable market, is the metric that takes the spotlight. But it really depends on the people watching and the people looking at the opportunity. But for sure, everybody is looking for big markets, because the point of VC is that they have to invest in things that they can, reach to 100 times the entry valuation. So exits that can return the entire funds by themselves. Mm-hmm. So you need to go after big markets, either currently big or potentially big going forward with very high growth rates. Think about crypto. So crypto here is not on this chart. You see transport, buildings, power. Crypto per se was at least $1 trillion markets that came to life overnight.
Yeah, totally.
And a lot of investors started investing there because of the speed, because of the sheer size of the market.
Super interesting.
And as it grew very quickly and fell quite quickly, and we'll see how it evolves. But you can see the same pattern evolving there.
Yeah. So yeah, another element which I thought was pretty cool, it's an obvious, non-obvious element, which is the scalability. And they mention how exactly, basically product in general, they need to have a tech foundation which is ready to scale, which I thought was interesting because it happens a lot that occasionally founders test markets and product through non-scalable product and services, and that's a fallacy. What they mention, which is again is a basic, but it's good to remind people and remind investors that basically the tech scalability should happen since day one, and I thought it was this pretty powerful. It's again obvious, non-obvious in a way.
Yeah, that's another interesting point. Well, what does it mean to be scalable? So that's the good question, because if we talk a lot about scalability, what's scalability? If you look at the technology, so whether the technology is scalable, software is usually scalable by definition, or the business model is scalable. What does it mean to be scalable? Is a factory scalable?
They kind of simplify it, just pointing at software, and that's it. Just saying, hey, we simplify it, just software. That's it. Just take it. Which is a good way of thinking, a bit oversimplified, but definitely like a solid one. But is it the only one? Well, I don't know.
I would say probably not. Probably not. Otherwise, we are, killing sectors of venture capital that have been around for decades and have been quite good at returning capital to investors. Think about life sciences, where scalability is another thing, not enabled by software, but enabled by other aspects of the economy. But again, scalability is a true driver because if you're after huge markets, you need to get that market quickly. Quickly means in a number of years, not a number of decades. And scalability means that your costs of expanding are marginally decreasing. That's true scalability. So acquiring one more customer costs less than all the previous ones that you acquired so far. So that's in a sense at least part of the definition of scalability that I like.
Interesting.
Between time, scalability, and size that enables a VC fund to look at the service and say, oh wow, I'm going to pay back my entire fund by investing there.
That's cool.
Possibly.
That's cool.
At least potentially.
The last point is the number 33222. Did you know about that, Nick? That's pretty cool.
Yeah, come on.
It's
triple,
cool.
double.
Exactly, which I like.
T2D3. There's even a name for that.
What's the name of it?
D3. T2D3.
Okay. Cool.
Double.
Interesting.
Yeah, it's so known in the market. Everybody knows the label T2D3.
It's powerful.
For 2 years and double for 3 years.
Is a good heuristic of thinking, I thought. It's basically saying that that's how you calculate traction and how you have a solid signal for traction, which is when revenue essentially triples the first 2 years and then it keeps doubling. And some argue that it should double up to the 8th year or something like that. But yeah, definitely it's something powerful. What's your experience with that? Like, is it part of your heuristic? Is it?
Well, we try to pattern match at least the future on the T2D3 scale, because we invest when there is a 1. Possibly not even a 1 on the revenues, on the net revenues line. So you need we need to think that the business we're investing in has the potential to actually grow following a T2, T3 sequence, because we come earlier as investor. You are looking as Series A, Series B investor, you start seeing that pattern. It's easier probably to see it actually get into life. But at the C stage, you're betting on the possibility that that pattern can come to life.
Nice.
I had another. Oh, well, actually, so let me add another comment on this, because that's so good and true, but things are changing, at least a little bit. Think about it. In the last 10 years, markets have been going up in just one direction, just up. So everybody was, rewarding top line growth. I don't know whether you have taken a look at the markets in the last few days, and you're taking a look at the multiples in the SaaS sector. The SaaS sector is the sector where this KPI, where this model applies. Not all companies are equal anymore regarding top line growth. The markets are starting to punish the companies with bad gross margin and reward the companies with good gross margin. Not only growth, not anymore. Take a look at Twilio. Twilio has excellent top line revenue growth and very bad gross margin. And Twilio is trading at, 3x revenues. This model says that in year 5, with 72 million recurring revenues, you are more or less a unicorn. That means that you are evaluated like 13 times revenues, less than 3 times, 13 times. The difference is gross margin.
Cool.
I'm simplifying a lot, but the market is changing. So there are new dynamics that we haven't seen for the last 10 years.
Yeah.
So let's see the new frameworks that will emerge that will not only reward growth, but even more good marginality.
Yeah, I mean, that's a great sign, actually. It's an improvement. It's actually a sign of mature markets, which is not only about revenue and the boosting of revenue, but actually is like operational, basically being very solid in terms of operation, and then focusing on gross margin and how exactly gross margin affect valuation. That's powerful and mature. To my eyes, that's pretty a good sign.
Yeah, that's interesting. I mean, I don't want to reduce all the Twilio story to just the gross margin, but that's a very strong indicator of value.
Extremely interesting. Extremely interesting. All right, let's go back to the news of the week, starting from the top raise from last week. So very interesting, like Series A-ish sort of rounds, in general, like pretty good size. Starting from Faba, smart toys startup, raising 3.7 million from Oltre Impact and CDP VC, which is the biggest round of last week, actually. So I thought it was very interesting. So for people that don't know, Faba essentially is trying to make toys that support kids and detach them from screens and help them actually listen to stories and games through a Bluetooth speaker, which is very, very like toy-like. And yeah, they have been like good. They had like a very good traction in their selling product, and that's a big deal for them in terms of actually being financed.
Yeah, not much to add here. So this is a very expert team with good knowledge of the market.
Yeah.
I am actually a user of the toy.
Nice.
So I know it quite well. Yes. And a happy one, I have to say. So very, very happy for the round. That means that I will have a further supply of small toys to add to the speaker.
Nice. I thought here was the big. I think I'm very curious to see how it's going to evolve the product in the future, because probably the content part is extremely scalable. Talking again about scalability, maybe the hardware is one way to get into the house, but actually like quality stories and content, that's definitely going to make a huge difference in terms of the growth of the company.
Well, this is a razor and blade model, right? So you purchase the speaker and then you start purchasing all the of the puppets that you add to the speaker with the collections of contents. So once you are into the house, it becomes an obvious platform to sell to, a mom, granny, grandfather, daddy. So they're small tickets, small enough to be a quick purchase, with enough a catalog to cover a few years of life of the kid, of the child. So it's an interesting model.
Yeah.
If anybody's curious about how it can pan out, they've got a competitor that's a German company that was listed with a SPAC a few years ago.
Oh, wow.
A couple of years ago, something like that. Then it's Tony's, and you can see that there is some market potential there.
Nick, you did some deep research on this vertical, I can tell.
Yeah, well, because I purchase, I want to know what I'm purchasing. That's for sure. I mean, that's for my kid, but for my child. So, that's the diligence.
All right, moving on. Barberino's barbershop chain raising €3 million from CDP VC and Business Angel. That's pretty interesting because that's another example on how some Italian startup really like sort of the chain and franchise model plus a little bit of digital elements, and I thought it was pretty cool. So Barberino is developing basically a chain of barbershop across Italy. They also have franchised basically beyond Italy, and on top of that they're essentially activating e-commerce on their own website for male care products. So that's a three way of building revenue, like a triple strategy. It's pretty cool.
Yeah, that's an interesting one because it's a digital business in a sense.
Yeah.
So started out in the physical world, then the e-commerce and the product lines, and then the horizontal growth with the new shops. That's awesome. An unusual type of startup in a sense. In Italy, we met a few with a similar approach. Think about all the poke houses out there.
Exactly.
The poke shops.
Exactly.
But again, very nice round, and we'll see how it evolves.
Yeah. All right, moving on to let's talk about medtech. Medea, telemedicine startup raising 2.5 million from Oltre Impact. So Oltre is really ruling basically last week with the different investments, and Medea is particularly interesting because I don't think it's the first time we talk about Medea. I think we probably mentioned it before, but what I was curious about was really like the kind of product that they're developing. So they're really providing telemedicine in a very sort of smart device way with minimal devices that can actually collect a ton of data, and you have basically physicians on the other end that can easily check your data, make sure that everything is fine, and they're basically doing it in some of the most critical areas, which is like heart disease, cardiology, dermatology, and other key areas for sure. So I thought it was very interesting.
Yep, I agree, and I agree with Oltre Impact being on fire this week.
Yeah.
And I have to say, I'm not that surprised that they invested in Medea because they come from the experience from Clinica Sant'Agostino, which they basically funded and grew to a very big company, to a very big enterprise. And they're basically, doing it again. This time from the telemedicine point of view than from the traditional clinic point of view. At least and my reading from the outside.
The other good part, if I'm not mistaken, is that they are already EBITDA positive, which actually that's an extra sort of bonus because they're doing really good already. EBITDA is excellent, so is beyond the startup phase, I would say, in a certain way.
That's a fair take. I agree with you. I wonder what's the plan going forward. But yes, it looks like, if those are the numbers, it looks like more something like, a small private equity rounds.
Yeah,
rather
totally.
than VC rounds.
Interesting. All right, Nick. Last news. Let's talk about our friend from CDP. These guys, they've been absolutely killing, and they keep killing, which is a great sign for the ecosystem. So last week was the news that CDP Venture Capital is launching Large Ventures, which is a fund with basically a total raise of 700 million. And the idea is to invest in scale up, essentially. So actually push the boundaries from the early stage up to the scale up phase. And the idea is to really cater that area which basically in Italy is still a little bit uncovered, if you will. So that's a very smart move, I would say.
Well, it is again a co-investment play. So they pledge to invest at least 10 million in at least rounds as big as 20 million and upwards. So 50% of the round. So it is a good way to attract international capital and somehow to de-risk the investment, because you're investing in a player with deep pockets. And as you know, we are not seeing so many rounds beyond the 20 million mark. So that this is for sure an opportunity. And as we are seeing many rounds, the 2 to 5, 7 million range, we can expect that there will be many, hopefully many rounds in the big buckets, and CDP is positioning to be a key investor in all these rounds.
Nice.
So they're covering end to end.
They are. And the question that we were discussing before is CDP becoming the new sovereign fund focused on tech, like Singapore style? So essentially, I was doing a little bit of research and seeing how exactly sovereign funds have in the past invested and who's on the top of the game. And that's pretty interesting because basically, according to CB Insight, the idea is that I believe, let me share something which is really cool. So in terms of number of equity investment in private tech, France with BPI is still on top. Basically, they have 27 billion under management. Then is the two basically funds from Singapore, Temasek Holding with 194 billion, and GIC, always from Singapore, with 350 billion. And then you have Malaysia with 35 billion. What I thought it was curious is that CDP, I think, is right now at a commitment of about 1.8 billion total, almost 2. Which tells me, they're growing, they're fast. There is still a lot of work to do to actually match the kind of volumes that historically, of course, Singapore is a way older, sovereign fund, and the other one are older as well. But, comparatively, we're still in the baby phase.
Yes. Yes, absolutely, we are, but growing. Yeah. So let me allow me a joke. Now I'm only going to wait for CDP Equity to set up a platform to acquire all the startups that have been developed by the CDP VC.
Exactly.
So they go end to end.
That's it, and then it's the perfect play. All right.
Jokes apart, that's an important contribution. We need also the later stage investors, and this is a very good engine to also have this part running. So
I agree. All right, Nick, thank you very much. It was a pleasure, and I'll see you at the next episode.
Yes, ciao, Jack. Have a great day.